At the start of 2026, markets had priced several Bank of England rate cuts into UK mortgage rates and short-term bonds. That consensus shaped the entire valuation case for house builders and mortgage banks, and it is now gone. On 21 May, Governor Andrew Bailey told the Treasury Select Committee directly a rate cut had been removed from the table because of the Iran war. That single sentence did more mechanical damage to UK rate-sensitive equity positioning than any single earnings miss this year, because it did not just delay one cut, it confirmed that the BoE's forward path had been structurally interrupted, not temporarily paused. The mechanism runs as follows. Bailey noted that market interest rates, mortgages, bonds, had already risen in anticipation of a frozen rate path, effectively doing the bank's tightening work without a formal hike. He called this tightening some time to assess. What that language obscures is the position pressure it imposes. Institutional holders of housebuilder equity had entered 2026 sized for a loosening cycle. The frozen path does not merely reduce the upside, it inverts the timing thesis that justified the position size. The unstated premise underneath the contrarian accumulation case in Taylor Wimpey and Barratt Redrow is worth naming explicitly. The Motley Fool's analysis on 27 May describes Taylor Wimpey's 8.7% dividend yield as a contrarian opportunity. That conclusion requires one premise to hold, that the dividend is sustainable. Taylor Wimpey's near 7p per share payout for 2026 is by analyst consensus not covered by expected profit. The contrarian opportunity and the dividend trap occupy the same share price simultaneously, and the frozen rate path is the variable that determines which one resolves first. Barratt Redrow's position is structurally different from Taylor Wimpey's, and that difference matters for how the repricing propagates. Barratt Redrow is trading at a 13-year low, with a price-to-earnings ratio of 9.9 against Taylor Wimpey's 12, meaning the market has already priced more risk into Barratt Redrow. The Q3 order book grew 13% to £3.5 billion in April. That operational signal and the valuation discount are pointing in opposite directions, which is the condition that precedes either a re-rating or a confirmation of the downside, and the BoE's frozen path is the deciding variable for which outcome arrives first. The participant timing asymmetry here is observable. Retail platforms show Taylor Wimpey as the second most bought UK stock on AJ Bell as of 27 May, with institutional short interest running alongside that retail accumulation. Retail entered first. Institutional short positioning was already established. The gap between those two entry points is not a wisdom differential, it is a timing structure. The question it raises is not who is right, but what the resolving condition is, and that resolving condition is not a peace deal. It is whether Bailey's time to assess language converts into an actual cut before the dividend coverage gap becomes a cut itself.
The demand side of the house builder equation has a second pressure point that the rate freeze analysis alone does not capture, and it runs directly through petrol at 159.43p per litre. Petrol at 159.43p as of 26 May is 26.6p more expensive per litre than on 28 February, the day strikes on Iran began. That increase is not a consumer sentiment signal, it is a cash flow extraction. Retail sales volumes fell 1.3% in April, the largest monthly drop in nearly a year, with data showing households explicitly rationing fuel use and drawing on March stockpiles. That behavior describes a household balance sheet under active compression, not one deferring a discretionary purchase. The counter-signal in the house builder demand thesis, the structural housing shortage, does not resolve against this compression. The shortage describes supply-side scarcity. Petrol at 159.43p describes demand-side capacity. These are not opposing forces on the same variable. They operate on different horizons. The structural shortage remains real and unresolved. The near-term question is whether prospective buyers can access mortgage affordability at frozen rate levels while absorbing 26.6p more per litre at the pump, and April's retail data suggests the absorption threshold has already been crossed for a material share of that buyer cohort. The OECD assessment in the 24 May reporting is the detail most participants appear to have priced partially. The UK will suffer a larger growth hit from the Iran disruption than any other G7 nation, with inflation potentially exceeding 6% in the worst case. That UK-specific exposure is not a macro backdrop condition, it is the mechanism by which the BoE's frozen path extends further than gilt yields currently imply, because 6% inflation in a frozen rate environment is not the same policy condition as the frozen rate environment markets enter 2026 expecting. The demand destruction reading has an invalidation path that matters for the holding period question. If the Strait of Hormuz reopens under a ceasefire framework, the 60-day structure Trump described on 24 May, petrol prices would not fall immediately to pre-conflict levels. The OECD explicitly flagged that effects would trickle through over the next year. Barratt Redrow's Q3 order book growth to £3.5 billion, reported 15 April, preceded the 26 May oil rebound to $100. That order book number is therefore a pre-rebound signal, not a post-rebound confirmation. The monitoring variable for housebuilder completions guidance, Barratt Redrow's 17,200 to 17,800 full-year range, is now contingent on whether mortgage affordability holds at current frozen rate levels through the completion window. If petrol stays above 150p while the BoE holds, the household budget compression that produced April's 1.3% retail sales drop does not reverse, it compounds. The leaning is that Barratt Redrow's 370p consensus target, an implied 42% from 261p, requires a rate path that Bailey has explicitly said no longer exists in its original form. The recovery path is real but requires the Hormuz resolution to arrive early enough to give the BoE the cover to resume cuts before the completion guidance window closes, and as of 26 May, that sequence has not been confirmed.
The resolution scenario has a specific structure that current sector positioning does not fully reflect, and understanding that structure changes which stocks absorb the repricing and which capture the recovery. The peace deal framework on the table as of 24 May features a 60-day ceasefire, Strait of Hormuz reopening with no tolls, and Iran resuming oil sales. Brent fell over 5% to $94.88 on 26 May morning before fresh U.S. strikes reversed a move back above $100. That intraday sequence, $94.88 down, $100 back up within hours, is the clearest available signal that the market is not pricing a resolution. It is pricing resolution optionality with a high failure probability. ING's Warren Patterson named the mechanism. We've been at this stage before, only for talks to break down. The sector weighting implication of that failure probability discount is not symmetric across housebuilders and banks. For Lloyds, approaching 100p with strong Q1 profit, the frozen rate path operates as a net interest margin support. Higher for longer rates improve bank spreads on the asset side. The compression risk for Lloyds runs through mortgage affordability on the liability side, where the same frozen rates that support margins also suppress new mortgage origination volumes. That is a slower moving pressure than the direct valuation hit housebuilders face, which is why Lloyds sits first on the AJ Bell buy list, while Taylor Wimpey sits second. Institutional and retail flows are not treating these two rate-sensitive sectors identically. The relative value gap between Taylor Wimpey at a price-to-earnings of 12 and Barratt Redrow at 9.9 encodes a specific market judgment. Barratt Redrow's operational improvements, order book up 13%, profit guidance up 16% to £568 million, are not yet sufficient to close the discount against Taylor Wimpey's Bank and net cash position. That discount widens further if the frozen rate path extends, because Barratt Redrow's profit recovery is more sensitive to completion volumes, which in turn are more sensitive to mortgage market conditions. The verification benchmark introduced at the outset of this analysis is Bailey's time to assess language, specifically whether that language converts into a resumed cut path before the completion guidance window closes. The 159.43 petrol figure is the inflation input that governs that conversion. If petrol holds above 150 and the strait remains partially closed, the BoE's assessment period extends, the rate-sensitive repricing deepens, and the contrarian accumulation case in Taylor Wimpey requires the dividend to survive a coverage gap that analyst consensus already flags as vulnerable. If petrol retreats below 140 on a genuine Hormuz reopening, not an intraday ceasefire signal, the case for sector reweighting back into housebuilders reactivates, but the OECD's one-year trickle-through estimate means the recovery in completions would lag the recovery in oil pricing by enough quarters to keep the risk structure elevated well beyond the point at which oil itself normalizes. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.